Welcome, everyone. Thank you for joining us today for our webinar on consumer debt and household vulnerability among low-income households in Canada. We're about to begin our presentation. We hope that you're comfortable and we look forward to spending the next hour with you. If you've joined us on a webinar before, you'll be familiar with these logistics, but if you're new, we hope that you'll take a few moments with us to look at our setup. Everyone joining us on the line has been put on mute so that we can conserve our audio quality. And our presenters as well will be joining us via audio only rather than video so that we can conserve bandwidth on the line for everyone involved. However, we do absolutely want to hear from you through our presentation. We'll be engaging you through the presentation with a few poll questions to hear your thoughts and knowledge, but we also hope that if you have questions for our presenters, that you will input them into the question box in the control panel at the side of your screen. We will have a time for Q&A at the end of the presentation, and we'll get to as many as we can. You'll also find in the control panel, there is a box for handouts. We have two there for you. One is a copy in PDF form of today's presentation. In case you'd like to access it quickly, you can download that right there from the handouts panel. And there is also a copy of the research report that will be referenced throughout today's presentation. So please feel free to access those at any time in the next hour. But if you forget to, we are going to be sending you copies of absolutely everything that we share with you today after the session within the next couple of days. So if you're registered or if someone you know has registered but isn't able to attend today, never fear, we will be sending you copies and links to the material. So that's our logistics for today. We would like to begin by acknowledging that we are joining you from Toronto, broadcasting from Toronto, which is situated upon traditional territories. These territories include the Wendat, Anishinaabeg Nation, the Haudenosaunee Confederacy, the Mississaugas of the New Credit First Nations, and the Métis Nation. Toronto is in the Dish with One Spoon territory. The Dish with One Spoon is a treaty between the Anishinaabeg, Mississaugas, and Haudenosaunee that bound them to share the territory and protect the land. Subsequent Indigenous nations and peoples, Europeans, and all newcomers have been invited into this treaty in the spirit of peace, friendship, and respect. Today, the meeting place of Toronto is still the home to many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in this community on this territory. We acknowledge and thank everyone on the line joining us from traditional territories across Turtle Island. We're very honored to be having this discussion with you, and we thank you for taking the time to join us today. My name is Glenna Harris. I'm pleased to welcome you to our session today. I am a manager of learning and training here at Prosper Canada. We work with partners here at Prosper Canada across all sectors to ensure that Canadians have access to financial programs and products and services that they need to develop their financial well-being, regardless of their income. We envision a future in which all Canadians and newcomers have access to free, high quality and unbiased financial information, education, coaching, or counseling when they need it. And we certainly see debt, knowledge, education, and recovery as part of that solution. We also want to again thank and acknowledge everyone on the line for the important work that you are all doing in our financial empowerment field. Here in Canada, we've now spent 8 months together navigating a new reality since the onset of COVID-19, and it's hard to imagine a more important time to be doing this work. It's meant a lot of continuous effort as well as personal and professional adaptation. So again, we thank everyone for your contributions, and we're so pleased that you're taking an hour with us today. We have an exciting presentation for you. Today, we're going to be sharing and reflecting on research conducted by our team here on consumer debt trends in Canada in recent years. We'll be looking at what do these debt trends look like in low and moderate income households? What are the factors behind the debt? As well as what about those different types of debt? What are they like, and what's going on for those types of debt realities? What can we learn about these types of debt for these income groups? We'll say a little bit about help available to Canadian borrowers, and then we would love to hear from you in the Q&A, as we mentioned. Throughout the presentation, you'll also sometimes see little footnote numbers referencing specific points in the research that can source more detail on the points that our speakers will be mentioning. And in the full slides for today, you'll see at the very, very back, there will be full citations. If you're someone who'd like to dive in even more to the research that is shared today, we'll have all that information for you in the deck. So we look forward to sharing all this with you in just a moment. And before we do that, I'd love to introduce our speakers. First, Alex Busick is a research and evaluation officer at Prosper Canada and has been with Prosper Canada for 2 years. His work looks at the impact of consumer debt on low-income households and also evaluation of financial empowerment programs. And on a personal note, he's thinking about getting a cat. So we all welcome Alex, and we hope that your cat journey goes well in the coming year. Vivian O'Dew has been working with the research team at Prosper Canada for over a year as well, contributing to this project as well as the evaluation of the National Financial Empowerment Champions project, among many others. She has over 6 years experience in monitoring and evaluation of global health programs in Nigeria, as well as in literature reviews and scans such as the one you'll hear about today. She's interested in public policy and impact on marginalized people. And in her personal life, she's recently taken up knitting and has 3 unfinished projects to show for it. So welcome, Vivian. And I'm super excited to see and hear more about your finished knitting projects in the coming year. And finally, my name is Glenna. As I said before, I manage our learning and training team here at Prosper Canada. We're excited to bring you financial education resources and training and learning events such as this one. And without further ado, I'm very happy to hear a little bit more from you before we hear from our speakers, because we always love to know a little bit more about who's listening. So we'd love if you could tell us a little bit in the poll that's on the screen in front of you now. If you could select the type of the part of the industry that best matches the type of work that you do. And you can select more than one answer if you are employed with multiple services that are shown there. And if you're doing work that's not represented on that list, please share more explanation in the comment box. So I'll leave this up for a few more seconds. All right, I'll close the poll in 5, 4, 3, 2, and 1. All right, so it looks like everyone listening in, you're doing about all of the work actually that we could possibly describe. Many of you are offering financial education, one-on-one counseling, and debt management coming in tied at a very close second. So thank you for sharing that. It helps to know who's listening in and to know that most of you are involved with one-on-one support in some way is very helpful for our presenters to know. And we'd also love to know a little bit more about the type of role that you're in. Our presenters are keen to know how you contribute in this field to help them visualize the folks that we're speaking with today. So if you have a sense of which of these roles would best match the type of work that you do, we'd love for you to tell us. Again, I'll leave this open for about 15 more seconds. All right, so I'll close in 5, 4, 3, 2, and 1. So Alex and Vivian, we've got about 2/3 listening in who would identify themselves as a frontline service provider. And then following closely, we have a three-way tie between manager supervisor roles, senior or director, and researchers. And we've got about 170 folks listening in right now. So that should give you a good sense of our audience. So thank you everyone for letting us know more about yourselves. And that's really going to help our presenters be able to formulate their thoughts as they speak to you today. So with that, I will turn over the presentation to Alex, who is going to tell us more about the consumer debt research. Over to you, Alex.
Thanks, Glenna. So hi, everyone. Thanks for joining on the webinar today. As Glenna has mentioned, our topic is consumer debt. And as you're probably aware too, debt is and has been a hot topic for a while now, from government, media, and those of you who work in frontline, from your clients as well, I'm sure, that you're used to hearing about falling interest rates, how families are taking on more debt than before, and large student loans to cover tuition. In particular, mortgages get a lot of attention because they have a large price tag, and the importance of the real estate market for financial institutions and the government. But there hasn't really been a lot of research done on all the other types of debt that are out there. Things like lines of credit, credit cards, student loans, auto loans, and high cost credit. Together, these all get labeled as consumer debt. And it's only recently that researchers have started looking at the impact of these kinds of debts collectively on household financial health. And of course, even less research has been done on how consumer debt impacts low income and moderate income households where mortgages are less common. So it was especially important for us to try and learn how consumer debt impacts households at these income levels. So on the next slide, you'll see how our research team set out to understand what consumer debt looked like for low and moderate income households in Canada. To do that, we analyzed the most recent StatsCan survey of financial security from 2016. Now, a lot has changed since COVID, especially in the realm of debt, loans, and people becoming insolvent. And I'll touch on that a bit later in the presentation. But right now, the 2016 SFS is actually the most recent, with the results from the 2019 survey being released hopefully next year. So the data that we've looked at gives us a good benchmark of where people were at as COVID happened, but debt levels have likely gotten worse. We also conducted a comprehensive lit review of Canadian research studies on consumer debt, keeping an eye as best as possible on the low and moderate income households that we talked about and how they use debt and repay debt and the supports available to them. And as Glenna mentioned at the beginning, our final report, Roebuck to Recovery, consumer debt of low and moderate income Canadian households in the time of COVID-19 is now available, and we'll be sending that out again after the webinar. So before we jump into our findings, on the next slide, I just wanted to take a sec and give some definitions of terms that we'll be using a lot in this webinar. So to start, I've said low and moderate income households a couple times now. What we mean by this are households in the lowest and second lowest income levels as defined in the SFS, and they have 5 different income levels. It's hard to give an income number attached to that because it wavers slightly depending on what type of debt you're looking at, but it's helpful to think of it as generally below $50,000 a year. As I explained briefly a second ago, consumer debt means all forms of non-mortgage debt. So that would include lines of credit, credit cards, high cost credit, student loans, auto loans, and then things like unpaid utilities. Finally, indebted households refers to households that carry a debt balance of at least one type of credit in the SFS. So when households on the survey are asked, for example, do you have credit card debt? The survey also follows up with what is the balance of your credit card debt at this time? And so if a household claimed that they carried a balance, they get included in indebted households. Okay, so on the next slide, we have a poll question for you, which relates to what debt looks like in Canada. So to start off, what percentage of low-income households do you think carry any type of debt? A, 72%, B, 63%, C, 49%, or D, 35%?
Thanks, Alex. I'll give a few more seconds for people to input their responses. All right, so we'll close this in 5, 4, 3, 2, and 1. So Alex, it looks like the top guess here is 72%, followed closely by 63%. So you're going to tell us what the right answer is, right?
Yeah, so the answer is actually C, 49%, which means that almost half of low-income households carry debt. So many, but not all low-income households are carrying debt of some sort. This means that while many households might use a credit product, they're not necessarily carrying debt balances. So it makes sense that we might have guessed maybe a little higher because things like credit cards are so very common. But if people are consistently paying those off and not carrying a balance, they wouldn't be counted as carrying debt. What's really interesting that we saw in our research is that the percentage of indebted households actually increases as income rises. So in other words, on average, the higher your income is, the higher your debt ends up being. This makes sense to us since mortgages have the highest debt amounts and in the hundreds of thousands, and mortgages become more accessible as your income goes up. So as we'll see in the next slide, our visualization of this data shows us how the percentage of indebted households grows as we move up in income levels. So you can see at the very top there is the lowest income level with 49% of households being indebted, and that growing all the way up to 84% of households holding some sort of consumer or mortgage debt in the highest income level. But it's not just about whether a household is indebted. I'm sure we've all heard the terms good debt and bad debt being used when talking about mortgages or payday loans, for example. These can kind of be overly simplistic, since it really depends on the details and context of a person's financial situation, but it points to an important issue, which is, can a household afford to pay for their debt? And that's actually the focus of the next poll question that we have. So my next question is, how much does debt cost for people? On average, what percent of their income do low-income households spend on debt repayment? A, 12%, B, 31%, C, 24%, or D, 63%?
Thanks, everyone. We'll leave this open for about 15 more seconds. And I'll close in 5, 4, 3, 2, and 1. So Alex, it looks like our winning guess is B, 31%, although it's a little bit more tentative than the guesses on our first question. So I'm sure we're all very keen to hear you tell us what the answer is again.
So the answer here is B, it's correct, 31%.
Oh, well done,
so even though fewer low-income households are indebted, as we'll see on the next slide, those that do carry debt spend on average 31% of their income on repaying debt. Now that's a lot if you think about it. That's a third of every paycheck, especially when rent or mortgage payments can take up a large chunk as well. So as you can imagine, high debt repayment costs can make meeting basic needs like rent or groceries or car repairs even harder for many low-income households. And what's really important here is to note that the Bank of Canada uses a threshold of 40% of income towards debt payment as an indicator of financial vulnerability. So with COVID-19, it's likely to increase the risk of low-income households becoming insolvent if they can't cover their debts. And keep in mind that this 31% is an average, so many households are probably already past this 40% threshold. In the next slide, we'll see a visualization of this percentage of income going to debt repayment. Again, the lowest income levels at the top, they're spending 31% of their income on debt, and that decreases as we go up in income. This leaves low-income households especially vulnerable, and it's very difficult for them to get under or out of these debt levels. On the next slide, so if low and moderate income households are less indebted but pay more of their income to cover their debt, we had a question of what kinds of debt are they holding exactly? Like I mentioned previously, it's sort of intuitive that mortgages, the biggest ticket credit type, are more accessible to people on higher incomes. Well, when we analyzed the SFS, we saw a very similar trend. So low and moderate income households had fewer mortgages than higher incomes. Instead, most of their debt was made up of consumer debt, all those other types that don't pay into an asset like a house or a condo that appreciates and helps them build wealth. So as you can see in this chart, at the lowest income level, 92% of indebted households on low incomes held consumer debt, but only 20% of them had a mortgage. And then there's a slight jump when we move to moderate income households, where suddenly 39% of indebted households have a mortgage. And so even this small jump in income makes mortgages more common, while consumer debts seem to be high across the board, regardless of income. So our next question is around what kinds of consumer debt low and moderate income households hold. So what kinds of consumer debt is the most common among low and moderate income households? A, student loans, B, credit card debt and installment loans, C, lines of credit, or D, auto loans.
Thanks, Alex. I'll leave this up for about 15 more seconds. See everyone's responses coming in. So I'll close this in 5, 4, 3, 2, and 1. So Alex, we've got a very consistent agreement on this one. We've got big guesses for B, credit card debt and installment loans. So I'm gonna hope that our listeners are going in the right direction here.
They absolutely are. B again was the correct answer. Credit card debt and installment loans are the most common kind of consumer debt, actually across all income levels. 59% of indebted low-income households and 56% of indebted moderate-income households carry some amount of credit card debt and installment debt. A quick note for those listening is that these two types of debt are actually quite different, but they're categorized together in the SFS, and that's one of the reasons potentially why it's so common, but also because of the ease of access of credit cards and installment loans. But that being said, as you'll see on the next slide, student loans and auto loans are also quite common. They're common kinds of consumer debt at these income levels as well. 24% of indebted low-income households carry student loans, which is actually higher than any other income level. And 36% of indebted moderate-income households carry an auto loan, which makes it the second most common for that income level after credit cards and installment loans. So in our analysis of the SFS, these three types of credit kept jumping out at us when we looked at low and moderate income households. And when we started focusing on them in the published research and our literature review, we noticed that each type, installment loans, student loans, and auto loans, were having particular impacts on low and moderate income households. And so we'll dive in really briefly on each one. But before we do that, I'd like to take another quick definitions break. The one thing you learn when researching debt is that there's a whole vocabulary to these products and how they work. So I'm going to go quickly through some of these definitions. I mean, knowing the sorts of folks that are on the webinar today, I feel like you're probably familiar with some of these, but it's worthwhile always as a refresher. So the first is principal, which is the initial loan or the amount still owed on a credit product. The second is interest rate, which is the amount a lender charges for a loan, and it's often expressed as a percent of the principal. So say I get a payday loan, and it's $400 with a 22% interest rate added every pay period. The $400 is the principal, but if I pay $200 of that before the next pay period, then my new principal is $200 plus the 22% interest added on top. A term length is how long a borrower has to pay back a loan or debt in general. So in our payday loan example, they are often tied to a person's pay period, whereas something like student loans or an auto loan will have years before a borrower has to pay it back in full. Repayment structure is related to the term length. It means how a loan can be repaid, whether in full or in installments or in each pay period, etc. Credit cards are actually a really unique one in this sense, since they're a type of revolving credit. So you can use it to pay for something and then pay a minimum balance each month and carry that debt forward continually as it piles interest. And finally, subprime loans are loans with high interest rates and other charges or fees that make the cost of borrowing very high. And subprime loans are often the only available option for people who have poorer credit histories. So jumping into installment loans. Installment loans are a type of high cost credit, meaning that they have a high interest rate and are actually the fastest growing form of consumer credit in Canada. They're becoming more and more popular as an alternative to payday loans and more accessible to people. But unlike payday loans, they actually have larger principals and longer term lengths. So an installment loan can range these days from $500 to $15,000, with term lengths varying from 6 months all the way up to 5 years. Now, this can be really dangerous for people on low or volatile incomes because installment loans require borrowers to pay a fixed amount in periodic installments over the entire life of the loan. So it's not like credit cards where you can pay a minimum balance for the time being. There's a fixed amount and it's set to a very strict payment schedule that locks borrowers in. On the next slide, for student loans, they really stood out to us in our research because the average student loan among low-income households was $15,000, and this actually dropped when we got up to moderate income households down to $12,000. This was kind of concerning for us because it points to an issue with student financing programs and that there may not be the help for low-income students that we think is out there. Student loans can also take much longer to pay off and can impact other major life decisions like delaying marriage, children, or large purchases like saving to buy a house or a vehicle. Another insight from our lit review was that borrowers that had some college, trade, or university education, so whether they be current students or people who didn't graduate but carry student debt, they're actually more likely than others to say that they're behind on one or more bill payments. So this suggests to us that they may still be struggling with this debt from their time spent in school, while not yet experiencing the sort of financial benefits that we typically associate with having a completed post-secondary education. Finally, auto loans were one of the more complex kinds of debt that we looked into, partly because they're regulated differently across provinces and territories, but also because they involve a car dealer or a broker as a broker between the borrower and auto lender. So on the next slide, with auto loans. Yeah. So a dealer will take a borrower's application, they'll liaise with multiple lenders who assess the borrower and their credit history, and then decide on the loan's interest rate and term length. But dealers may only show borrowers options that provide them with a better commission at the expense of the borrowers being able to afford it. We also found that dealers are increasingly offering extended term loans of 7 to 8 years as opposed to the 3 to 5 years that was previously common. In fact, extended term loans now make up 69% of all auto loans in Canada. So while that may make it more affordable month to month for lower income borrowers, it actually adds much more interest in the long term over the entire length of the loan. And as I mentioned earlier, borrowers with poor credit history may only have access to costly subprime loans. Subprime auto loans typically have interest rates between 15 to 28% plus additional fees on top of that. And when the cost of a vehicle is so high, these interest rates really add up. So I'll pass it off to Vivian now, who's going to tell us a little bit more about how households use their credit.
Thank you very much, Alex. So in the next couple of sections, we'll be reviewing the uses of consumer debt, as well as the contributing factors to over-indebtedness among low and moderate income households. As Alex has mentioned, indebted low and moderate income households carry many different forms of consumer debt. And from the names of these types of debt, we know what they are used for, as with student loans or auto loans. But there are other forms of credit, like installment loans, credit cards, and lines of credit. And the question we're trying to answer is, what are these kinds of debt used for? And what our research has shown is that there are two important ways in which low and moderate income households use debt. The first is to pay for living expenses, both expected and unexpected living expenses. When low-income households cannot cover their living expenses with employment income or savings, they often turn to borrowing using different forms of credit, including high-cost credit products like installment loans and payday loans. A study in 2016 by the Financial Consumer Agency of Canada found that almost half of respondents to the survey, which was comprised of payday loan users, reported that their loans were used to cover unexpected but necessary expenses like car repairs, as well as recurring and expected necessary expenses such as rent or utility bills. So they were basically using these loans to finance their cost of living. What we also found interesting was many low and moderate income households are using debt to repay other forms of debt. As you recall, Alex mentioned that low-income households spend about 31% of their income on debt repayment. But in addition to using income, some households are also using debt to repay debt, and payday loans are also used in this way. In fact, a third of payday loan users in the study I referenced earlier reported taking out new payday loans from another lender or using bank account overdrafts to repay their outstanding payday loans. So these are the two important and unique ways low and modest income households use debt. This, of course, is in addition to the other uses of consumer credit that we've seen, like paying for higher education and for the purchase of vehicles. In the next slide, we'll be looking at the drivers of consumer debt. And we have a question here. What are some of the factors that contribute to high consumer debt levels in Canada? You can type in the chat box what you think the drivers of consumer debt are in Canada.
Thanks, Vivian.
Yeah.
We have a couple of responses coming in. People are suggesting job loss or unemployment, car repairs, low wages being suggested, cost of rent as well. A few people, and then different types of spending, holiday spending. Yeah, so lots of suggested answers coming through here. So we're looking forward to hearing you tell us more. Yeah.
Yes, so everyone, all the suggestions you provided are correct. These are some of the drivers of indebtedness. And as many of you might suspect, there's no one factor responsible for the high levels of consumer debt we have in Canada. There are a lot of factors, and these factors are interrelated. So to simplify things, we've tried to divide them into two groups. Basically, we have the borrower side factors and the lender side factors. So the drivers of indebtedness that are the result of consumer behavior, actions, or characteristics are considered borrower side factors, while those that are the result of the practices and products of the financial industry are called lender side factors. And many of the factors you mentioned in the chat are what we've classified under borrower side factors. As some of you mentioned, the first here we have in the next slide is wage stagnation, as well as the cost of living expenses. So wages, as we all know, are the most important sources of income for most Canadian households. But over the last 30 years, wages have stagnated for people in low and moderate income households. And in addition to this, the cost of living has outpaced wage growth for the vast majority of consumers. So when people cannot turn to their employment income to finance their living expenses, they often turn to borrowing. In fact, some scholars have argued that the rising levels of consumer debt we have should be understood not as a sign of overspending, but rather as a rational response to stagnant wages and higher living costs. And related to the stagnant wages and cost of living expenses is household savings rate. The household savings rate is the percentage of disposable income that the household saves rather than spends on consumption. And if, as we've seen, wages have stagnated, it makes sense that the household savings rate would have declined in Canada. And that's what we've seen. The personal and household savings rate in Canada has been steadily falling from 19% in the 1980s to about 4% in 2014. I said recently because if you have access to reports from Statistics Canada, you'll see that the household savings rate in Canada recently reached an all-time high of about 28.2%, which is likely as a result of the social transfers and social assistance support from provincial and federal governments. But before the COVID-19 pandemic, in the preceding years, the household savings rate in Canada was 3%. So in an environment of where wages have not kept pace with the cost of living and in which the savings rate is low, it makes sense that people will often have to borrow to meet their financial obligations. The next factor we are considering under the borrower side factors is credit history, which Alex referenced during his presentation. A very common attribute of many users of high-cost credit products like installment and payday loans is an impaired credit history. Many payday loan borrowers report that they have been refused a credit card by a mainstream financial institution due to their poor credit history. This is in contrast to high-cost lenders like installment and payday lenders, who often advertise the fact that they are able to advance loans to people without performing credit checks. So as a result of this, people with poor credit history often have to turn to these lenders when they are unable to access credit from mainstream financial institutions. Another factor under the borrower side factors is the financial literacy. The interest rate on many credit products is below 60%, like for lines of credit, credit cards, student loans, they're all below 60% because 60% is the criminal rate of interest in Canada. However, payday loans are exempt from federal laws on interest rate. So because of this, many payday loans have interest rates as high as 400% compared to credit products which have interest rates well below 60%. Many users of high-cost credit products like payday loans may not understand how high the interest rate on these loans are, and therefore how expensive these products turn out to be. So we argue here that perhaps if payday loan borrowers really knew, if they had the financial literacy and they had the knowledge and knew how much they were paying to service these forms of credit, they would be less likely to turn to these forms of credit in times of financial hardship. So these are the borrower side factors behind the high levels of consumer debt in Canada. In the next slide, we'll be looking at the lender side factors. What has happened in the financial industry that has contributed to the rising levels of consumer debt? And the first factor we'll see is financial innovation. So financial innovation here, we refer to both the forms of the new credit products that are available, which we've gone over before. Installment loans are relatively new. Lines of credit, home equity lines of credit, these are all new forms of credit products. But in addition to this, there are also newer lending practices like extended term contracts, which Alex has described. So the range of credit products and the terms under which they are made available to households have contributed to the rise in consumer debt levels across income quintiles. So we argue here that as a result of these newer lending practices, which have occurred alongside the newer financial instruments and products, which together, this has made borrowing more accessible to many households across income quintiles, but also to people in low and moderate income households. Another important lender side factor is interest rates. Nominal interest rates have fallen over the past 20 years, and as a result, borrowing has become cheaper. A Bank of Canada report in 2012 found a significant negative relationship between interest rates and credit growth. In other words, the lower the rate of interest, the higher the rate of growth of credit. And this is reflected in the rising levels of consumer debt we've seen in Canada. Financial exclusion is the next factor under the lender side factors. Many low and moderate income households lack access to credit products from mainstream financial institutions because of their credit history and also because of where they live. So payday lenders are more likely to be found in low-income households compared to the mainstream financial institutions. So either as a result of their poor credit history or because of where they live, many low-income Canadians often turn to alternative financial institutions like payday lenders who offer products with high interest rates that push consumers further into debt. And related to that is subprime lending, which Alex has described. Subprime lending is the provision of loans to people under terms that make repayment difficult, usually with high interest rates and other fees attached. And this is what we've seen with auto loans. Car dealerships have been known to promote the sale of add-ons, which are unnecessary fees that are tacked onto the price of the vehicle. These add-ons include things like administrative fees or life insurance policies that are of little or no benefit to the borrower, but serve to increase the cost of borrowing and push households further into debt. So this list of factors, financial exclusion, subprime lending, interest rates, financial innovation, and also the driver side factors we've seen, is not an exhaustive list. There are other contributing factors to over-indebtedness, like rising house prices, but we've tried to limit ourselves to the factors we consider as most important for low and moderate income households. And those are the factors we've explored in this section. I'll now hand over to Alex for the remainder of the presentation. Thank you.
Thanks, Vivian. So on the next slide, now that we've gone over what debt looks like for low and moderate income households, the impact it's having and where it's all coming from, what help is really available to Canadian borrowers? As I'm sure many on the webinar are aware, our research showed that there's actually few sources of free quality financial counseling available to Canadians who are struggling with their debt, but weren't yet at the point of insolvency or bankruptcy. So, for borrowers who continue to make regular payments but struggle with their high debt loads, those free, neutral, quality counseling supports just didn't seem to be available. Moreover, some of the client research we saw or market research we saw on the financial counseling supports that do exist for insolvent borrowers showed a little bit of unevenness in quality, and borrowers reporting having very mixed experiences. And this was really the issue, because helping people who are overloaded with debt before they become insolvent is really what we want to focus on. In the next slide, you'll see a chart that sort of lays out these options for both insolvent borrowers as well as those approaching insolvency. So this chart just gives a really brief overview and comparison between options. The top two rows are for borrowers who are insolvent, so they don't have any money or assets that they can use to pay back their debts. For these borrowers, bankruptcy or a consumer proposal are really the only two options, and they're both fairly strictly laid out processes with legal implications that require the support of a licensed insolvency trustee, etc. For borrowers who were approaching insolvency but not there yet, the more widespread options available to them, things like consolidation loans, debt management plans, or orderly payment of debts, didn't provide a mandatory counseling piece. Sometimes people who offered debt management plans provided this counseling, but it wasn't required like it is with bankruptcy or consumer proposal. And we know from other research into financial health that financial counseling or coaching can play such a pivotal role in people cycling through their debt issues and finally coming to manage their debt in a healthier way. So a big takeaway from our research was the need for that counseling piece to be expanded when it comes to free and affordable debt services for struggling borrowers. On the next slide, we're going to talk really briefly about the impact of COVID-19. As you can probably think, these supports are more important now than ever. Like I said at the beginning of the webinar, we know lots has changed in people's financial lives due to COVID-19, and debt is a major area where this is the case. So although we haven't done as thorough of an analysis yet as we did with our research into the SFS, some of the early survey research that Prosper Canada has conducted post-COVID shows that the onset of COVID-19 and the following 6 months has found that 30% of low-income households say that their personal debt level has worsened. 43% of low-income households say their savings have worsened, and 21% of low-income households report a negative impact on their ability to pay bills on time. And these figures are all worse among Black, Indigenous, and other racialized communities and households, which really highlights the need for targeted services for these communities. And as you'll hopefully see if you're signed up to Prosper Canada's mailing list, we should have a release around the results of this survey coming out very soon. Finally, in acknowledgements to all the people who are involved in this extensive research project, first to the members of our advisory committee who provided really valuable insights and guidance. That would be Gail Henderson, Jody Litzkovich, Renee Morissette, and Michelle Pommels. And then also thanks to everyone listed from Prosper Canada who at some point or other had their fingerprints on this research project and provided really useful feedback to our team. It was invaluable.
Thank you, Alex and Vivian. That was a jam-packed presentation. You've covered quite a lot of information in a relatively short period of time. So we really thank you for sharing all of these insights with us. And as you've said, there's a lot more in the report. So if you're able to download that from the handouts panel there on the side of your screen, you can dive right in as soon as you would like. But we want to give people a chance to ask questions, and we've had a few coming in. So Alex and Vivian, I'll I'll start sending them your way if that sounds good. We had a couple. Alex, at the beginning of the presentation, you talked about the what's included in your debt payment ratio, and we had a couple questions around housing costs and would rent be included in that definition? Could you speak to that at all?
Yeah, totally. So the actual sort of statistical term that's used for debt repayment ratios is called debt service ratio. And basically what it looks at is the ratio of one's income to one's debts, and that either includes interest or sometimes it doesn't include interest. But likely rent would not be included since it wouldn't be considered a type of debt or credit. It's not money that's been or credit that's been extended to somebody that they now need to pay back. Rent would probably be included in a cost of living analysis or something like that. But mortgages would be included since it's something that they're paying as a form of debt back to likely a bank or other financial institution.
Okay, all right. Thank you for that clarification. We have a couple more coming in, and everyone, if you have questions, please feel free to type them into the box. We'll get to as many as we can in the next 10 minutes. We had a question about, so Vivian, you were talking about predatory or the challenges of payday loans and high interest, and if people had higher financial literacy, maybe they would make a different choice, kind of thing. But we have a question around, but what if there aren't any alternatives to that? And that's a tension that can still be there. I wondered if Vivian or Alex, if you had any other thoughts on that.
So yeah, the person is right. The question is pointing in the right direction. What we argue in the main body of our report is people often turn to these alternative sources of credit because they can't get credit from the mainstream financial institutions. We argue that if they knew how much they would they pay to service these forms of debt, they'll be more likely to turn to other sources of credit. Like maybe they'll turn to a family member first, or turn to friends, or to their colleagues, or before going to these other sources of credit. But if these other sources are not available, like if they can turn to their family or friends and they have no employment income, then yes, it makes sense that they often have to go to payday lenders to get credit.
Okay, thank you. Thank you for adding that. We have a question, and Vivian or Alex, whichever one of you would like to respond, we have a question about if the credit score has been assessed for low to moderate income level. Did your research take you into credit scores and how those may differ between income groups?
I can touch on this really briefly. You know, getting accurate research on credit scores is actually surprisingly difficult. We did sort of skirt around it in our research, but found that most organizations or companies that provide credit scores hold closely to them. They're considered proprietary information, proprietary data, and so it's not very easy to look at that, especially in a way that's sort of broken down by income level. Instead, most of the published research just refers to credit history. And so that's obviously not identical to a credit score, but they're very intimately related. And it would refer to, one's how capable they are of paying their debts, that sort of thing, but also their credit score would likely reflect the types of credit they have and how many times they defaulted, things like that.
Okay. Okay, great, thank you. Yeah, I know credit scores weren't a part of your research, but it's great to have that connection because these things are also related. We have a question as well, and again, I'm not sure if this would be better for Alex or Vivian, but given that your research was talking about the challenges of accessing a quality financial counseling program, do you have any other thoughts there on your research of what makes a financial counseling program successful? Like what would you say are good directions there?
That's a good question. I mean, it's really complex, right? Depending on what issues someone's facing. I would say that knowing the ins and outs of the current of it, like supports available to people who are insolvent, is really important. Lots of folks who are struggling with debt don't realize that, you know, filing for bankruptcy is not a simple thing, and it requires you to liquidate your assets. It's not often the best option. But often, you know, that word bankruptcy is the one that pops into people's heads because it's common and it's, you know, it's in our everyday vocabulary. Also, you know, as the chart, and you can, folks can look at it a little more deeply in the report, but as the chart lays out, some options are actually only available in certain provinces. Orderly payment of debts is one of those, which is a provincial program that's only accessible, I believe it's in Alberta, Saskatchewan, Nova Scotia, and Prince Edward Island. And it basically allows someone to pay back their debt to the government in terms of, you know, they take on their debt and then they pay it back in sort of regular, affordable installments with a lower interest rate. And so things like that are really unique, but are also always changing. And so really knowing what supports are available there, I think, and what works best for the particular client's or person's financial situation is key. Would you add anything, Vivian?
Yeah, so I agree completely with what Alex has said. It depends on what situation the person finds himself in. Like we've been going through reports about financial counseling for quite a while now. And the sense you get from many people is they don't want to ding their credit scores or their credit, they don't want to make their credit histories worse. So they want to go into, say, consolidated loans or things like that. But if they go to a good financial counselor, then they'll be able to tell if they need maybe a consumer proposal or a bankruptcy proposal. So it depends on where the person finds himself or herself and what situation they're in and what they can afford. So there's no straight or simple answer to what's a good financial counselor. Depends on the situation, yeah.
Okay, great. Yes.
I would also add to that, that just like there are sort of specifics to the financial counseling supports or the debt supports that are out there, there's also really specific things around how different types of debt work, like we looked at. And so, you know, with high cost credit, when they have really high interest rates, it might be a bigger priority for someone to pay off something with a really high interest rate than it would for someone who has, you know, debt that's at a much lower interest rate. And so really getting into the nitty gritty of what a person's debt load looks like, what it's made up of, and what the interest and term lengths are on all of those types of debt, it's easier once doing that to sort of prioritize, okay, this needs to be addressed first because it could really lead you to being overwhelmed with debt versus something that, you know, maybe you can carry this credit card amount a little longer and it won't add up as much interest in the meantime.
Okay, great. Yes, thank you both for that added context. That's important. Speaking about the importance of tailoring and the type of solution might be very different depending on the debt situation. We have a question around interest rates. Vivian, I think this might be more relevant to your portion of the presentation, around what's the most interest that any lender can charge, and is this different from province to province?
Yes. So for most credit products other than payday loans, they can charge above 60%. 60% is the criminal rate of interest of product. But even if you look at things like installment loans, which are forms of high cost credit, the interest rates are usually in the range of 28 or 30%. For credit cards, we know it's usually 18%, 20%, or in that range. So financial institutions can charge above 60% for the financial products they put out. But for payday loans, they're allowed to charge above this because they are regulated at the provincial level and are not subject to federal laws on the criminal rate of interest. So you can get things as high as 300%, 400%. I don't know if that answers the question. Yeah.
Thank you, that's great. And I want to encourage everyone, if we don't get to your question or if you want more answers or more details, please get in touch with us after, and I'm sure Alex and Vivian would also be very happy to follow up with more resources or more information, because I know time is short and I want to try to get to as many questions as we can. Vivian or Alex, we have a question around, is there anything in the research on the longer term impact of debt for seniors on their quality of life or their ability to save for retirement?
Yeah, you know, when we initially started this research project, one of the things we wanted to look at was the sort of physical health and mental health impacts of debt loads on all people. What we found very quickly was that there are very few Canadian studies on that subject. The majority of them come from either the UK or the United States, which gave us some insights, but you know, everything's going to be more specific depending on the context of the country. And so there wasn't a lot out there right now, but I would say it's definitely an area that we'd like to focus on in the future and try to dig into more.
Yeah, and in addition to that, what we didn't see a lot, like Alex said, but we do know that there's some evidence that high debt levels among seniors could lead to delayed retirement as debt servicing costs increases. So there's a tendency for households to forgo other financial obligations, like saving for retirement, when they have to service the cost of their debt. So that's one impact on seniors.
Okay, thank you. We have another question around if there's, you spoke about cost of living or the increased cost of living on this, but can you say a little bit more around, you know, sorry, I'm just trying to find the question again. My apologies here as I'm looking through. Basically, has the increased cost of housing paralleled the increase in debt?
I would say yes, because in our research, even though we try to limit ourselves to factors that are more important for low and moderate income households, something we found in the literature is that rising house prices kind of go together with rising levels of consumer debt. So as house prices have increased, consumer debt has increased, mortgage debt has also increased.
Yeah, I would
that would in fact be included.
Yeah, I would echo.
Go ahead, Alex.
I would echo what Vivian just said, and I think that it was really important for us when we were doing this research, even though we were focused on consumer debt because there wasn't as much research specifically on all of those types of debts, especially when they're more common among low-income households. But it was important for us to keep in mind that there's really only one financial ecosystem, and so what might happen, you know, to impact house prices and people with mortgages will have downstream effects on all other sorts of forms of credit and debt as well. And so there's definitely a relation there.
Thank you. Thank you both. And I appreciate that there's a lot of nuance in some of these answers. So so thank you for your comments there. I'll just give you one last question. Hopefully this is a quick one. Do we have any sense of how this data compares to other G7 countries?
Yeah, so I mean, one of the things that really drove this research at the beginning was the fact that Canada had one of the highest debt to income ratios of any G7 country, which is pretty shocking. What really stands out to me in our research compared to the UK or US, for example, is both the types of debt that people have, but then also the supports that are available there. And so you'll see in our report, we talk a bit about this, that, you know, the UK, Australia, and New Zealand are actually ahead of the game when it comes to things like government funded financial coaching supports or debt management supports. They've really made a big push there. But when we think about like what types of things are causing indebtedness among people, again, it really depends on the other factors in those countries. And so like in the US, for example, medical debt is huge because of having a private medical system, which we don't really see here. But obviously credit card debt here is exploding. So and installment loans are really rising quickly. And so those are some of the more obvious differences. But yeah, there's a couple sources in our report that you can check up on that have more in-depth comparisons across countries.
Perfect. Thank you. And thank you, everyone. I realize we've come to the end of our time today, and we know that there's a few more lingering questions. We want to encourage you to please get in touch. I'm sure our research team would be happy to answer more and follow up if there's something we didn't get to today. But just to say again, we'll be sending you with all the information that we shared today, a copy of the slides, the reports, as well as the video recording, so you can dive into it or share with anyone else you think might be interested. We hope that you'll respond to our survey when we send that as well with all these materials. Our research team would be very keen to know how relevant this work is for what you're doing. We hope you'll join us again in December. We will soon have registration available for 2 upcoming webinars in a few weeks, both on the subject of virtual tax filing support. So we're going to have speakers from CVITP joining us on December 2nd, and then the following week we'll be hearing project insights from a few of our community partners in Ontario who participated in a pilot project with Intuit. So please look out for those registration links coming soon. If you're subscribed, you'll get those emails from us directly. Please join us on our Learning Hub for webinar materials and all other resources that we have to share. And please be in touch. We'd love it if you could subscribe so that we can let you know directly when we have more learning events such as this one. And we'll leave our contact information for all of our presenters here so that you can follow up if you'd like to know more about what was said today. Again, we thank you so much for joining us for this hour. We know your time is very, very valuable, and we hope that you have a great afternoon and a great weekend ahead. So thank you, everyone.